What's up guys, Jake here. In this video, I'm going to share with you one of my favorite options trading strategies, and that is selling out of the money credit spreads on the S&P 500 index. If you're not familiar with credit spreads, then definitely check out my playlist on trading options. It's this video right here, Credit Spreads Explained. I also do examples on Tesla and JP Morgan in this video. But in this video, I want to do it on the S&P 500 index. Why would you want to do this? It's because the index is less volatile than an individual stock. Individual stocks can have really wild swings, up or down 10% in a day sometimes. But with the index, it can have dramatic down days, maybe losing 2, 3, 4%. But it rarely has a dramatic up day. So we're going to be selling a credit spread just above the index, and if the index goes down or trades sideways before your expiration date, you can make money very easily on a out-of-the-money credit spread. Now, full disclaimer, the last year probably hasn't been the best year to do this strategy. The reason for it being is because the S&P 500 index has pretty much only gone up, and you don't want that to happen when you're selling bear call spreads. These are credit spreads. However, you look at the index and you notice these sharp dips. One here, one here, one here, one here, another one here. The market just tends to have these freakouts every month, month and a half. So what you would want to do when using this strategy is to sell a debit spread just above where the market is if it's at an all-time high. Wait for one of these freakouts, and then sell to close your spread for whatever profit you can get. Wait for the market to snap back, and then reopen your position. And before we get into my Schwab account, once again, let's just recap the 4 kinds of vertical spreads. There are the 2 kinds of credit spreads. You're receiving a payment today, and the 2 kinds of debit spreads. You're paying to play with these. And the bull call and the bear put are very speculative forms. However, because you're buying a call and then selling one at a higher strike, the premium is more affordable if you can capture share price movement. And when you're selling a bear call or a bull put, this doesn't require you holding 100 shares like it would be for a covered call, or buying 100 shares like it would be for a cash secured put. So you're not locking up collateral when selling credit spreads. And we're net selling credit spreads to collect that premium. Theta decay is our friend. By selling an option for a premium and then buying another for less premium, we're basically capping how much we can make. It's just the credit we receive today, but we're also capping how much we can lose should the share price unexpectedly move on us. So let's look at the chart once again to recap what's going on here. And with a bear call spread, which is what we're doing on State Street's SPY today, I don't necessarily think the market's going to go down. It could just trade sideways. Trading sideways is good enough for me. So we're going to sell a call to collect a premium. I'm going to go with a delta value of about 30%. And once again, this is very risky. Your broker doesn't allow it. What if the share price just skyrockets? Now, I don't think the S&P 500 index is going to do that in a short period of time, but your broker still isn't going to allow you. So we have to buy a call. This is we're making a payment here to cap any potential losses should the share price shoot up unexpectedly. However, if this credit spread that we're selling, if the share price of SPY trades sideways, goes down, or only goes up to where our break-even price is, then we make money. So your break-even price is the credit you're receiving today above the strike price for the call that you sold. If you're still confused, don't worry. We're going to do a live example right now on Schwab, and hopefully once you see all the inputs, it'll make more sense. Here is the option chain for SPY, and we're going to go with an expiration date of August 20th. This is in 17 days. So theta decay is wasting away the value of these contracts really fast, which is what we want as a net seller. For custom range for the strikes, let's just do our own. and we're going to do just out of the money, so we'll do 438, and then I want to see all the strikes above where it's out of the money, so let's do 452, and then we're going to switch on the Greeks because I want to reference delta. So here is the strike 439, the current share price is 439443, and delta, we're looking for about 30%. Now, if you watched my video on the Greeks, you might want to reference IV, and IV is very low. One, because these contracts are only about 2 weeks out, but just the market hasn't been that volatile, so IV is pretty low. So the premiums aren't great, but once again, this ETF is very predictable, very boring, very safe, and I like making money. So let's go with the delta value of 0.28, and what that means, according to the Black-Scholes formula, is that there's a 28% chance that the share price in 17 days will get above 445. It's possible. Now we now need to determine the width of the spread that we're selling, and let's go with 450. I don't know if this is a good width. We're going to build the chain and then think about if this is what we want the width to be. So we're selling to open the strike that is closer to the current share price, and then we're buying to open the further one. So I'm going to be paid a credit of 177 for the one that I'm selling, but I then have to pay 53 for the one that I'm buying. So my net on this credit spread is 124. Now, what am I risking? Well, you have to look at the width. It's $500 minus the credit because of your break-even price. So I'm risking 376 to make 124. So just think about that ratio. I can make max $124, and I'm risking 376. I think that's pretty decent. I'm going to go with this spread over the next 17 days. And if we want to be a little neurotic, once again, we can look at the charts, and the S&P 500 isn't at all-time highs. I wish I was selling it while it was at 440 or 441, but it's pretty good there. I'm reasonably confident over the next 2 weeks with everything going on in the world that the market might have another one of these freak-out pullbacks, and then I would sell to close, buy to close my contracts to exit the position. So it's very likely, well, one, if the market just trades sideways or drifts down, then I'll collect this entire premium. I'll let everything expire worthless out of the money. But if there's a very dramatic shift, you know, if you've got the gains, you can always lock them in. Sell to close, buy to close your 2 contracts, exit the position. Just wait for the market to bounce back, snap back, and then reopen it with a higher strike potentially to collect more premium. Now, because I like this trade and I'm doing all this work, I'm actually going to increase the quantity to 2 and sell 2 of these. So I'm looking to make now, I'm looking to make $254 over the next 17 days. Now, once again, credit spreads have risk. If you're selling a covered call or selling a cash secured put, you have the stock. You can always hold the stock or sell the stock for a profit when your strike price is above your cost basis. But with a credit spread, you're just losing money if the share price moves against you. But I like this trade. It's once again risk versus reward with all these vertical spreads. I'm going to go with it. So there we have it. The trade is now showing up in my Schwab account. Once again, this is on the ETF SPY. I sold 2 calls for a strike of 445, and I bought 2 calls for a higher strike of 450. Most I can lose is like 700, and the most I can make is like 250. I like this trade. I'm going to be watching it over the next 17 days, and I think, yeah, in the future, I'm going to be constantly selling credit spreads one direction or the other on SPY to try and take advantage of theta decay. Okay guys, if you like this video, give me a thumbs up so the algorithm knows it's good. In addition, check out my entire playlist on trading options. Lots of great videos for you to learn more about vertical spreads. If you have any comments or questions though, I'm always happy to help if I can. Let me know down below. Till the next video, take care.